Well, the euphoric reaction on some global markets to the proposed latest Greece debt deal, is it an overreaction given nothing has actually been agreed on? And will it change Greece's long-term problems anyway? Meanwhile, in the US, consensus has the US Federal Reserve moving later in the year to raise interest rates. Now, that would be for the first time in 9 years. So, according to my next guest, a whole generation of financial market operatives have never experienced a rate rise in the US. It's been 7.5 years since the Fed last tinkered with rates, and that was a rate reduction. Well, global fund manager PM Capital, portfolio manager Uday Cheruvu joins me tonight. And Uday, you've been freshly returned from the United States, but before we go there, Greece, your thoughts on this current outlook? I mean, nothing's actually really changed in the past 24, 36 hours, but at least the likes of Christine Lagarde are talking positively about something coming from something.
Yeah, look, what's happened in the last 24 hours is it seems the Greek government has put forward a proposal, put forward some sort of concessions that they're willing to make to the EU ministers and to the creditors. We don't know exactly what these are, but the fact that they're actually willing to make these changes is seen as positive by the markets. Now, is it truly positive? It's very hard to tell at this point in time. But in the long run, the EU wants Greece to be there, and Greece wants to be in the EU. So we are seeing signs that there could be some sort of resolution in the near future.
All right, so if there's a resolution, what is the likely impact on markets? I mean, we saw them initially, but they won't keep going up on this promise of a deal, will they?
No, definitely not. The market does need to see more positive movement today and some sort of clear proposal of what Greece is going to do. Now, it's for one thing putting forward a proposal, and the second thing the market has to evaluate whether this proposal is credible, whether in the long run it actually means that Greece can actually recover and get to a stable position. Now, in the long run, the size of Greece's economy is so small that even if this proposal comes through, even if this proposal is accepted, will actually improve the EU economy? No. So from our perspective, the euphoric reaction that you are seeing is more investors taking a deep breath and relaxing that maybe there won't be a disastrous event like a Greek exit.
All right, and even if there is a deal, is it really going to fix Greece's long-term problems?
Well, that's quite hard to tell at the moment. I mean, if you look at what's been happening in the last couple of days, public in Greece have stopped paying their debt. People are taking money out of the bank. People are putting money under the mattresses. It takes a long time for this sort of a negative event to go out of investors' mind and go out of Greek public mind. So, will it actually change anything in the short run? Is it actually good in the long run? It's hard to tell at this point in time. It'll all come down to how over the next 2-3 years the Greek government manages their position.
Uday, you've just returned from the US, checking out PM Capital's investment holdings there. But before we talk about them, what do you think is going to happen with rates? Are you with the consensus?
Yeah, look, I think coming back from the trip, the one point that came to me is that the Fed will raise rates second half of the year. In our view, it's likely to be sometime in September. Maybe they'll raise in September and then again in October.
Yeah, and just by the smallest amount, 25 bips?
Yeah, look, they'll start with 25 basis points because it's unlikely that they want to muddy the waters too quickly. They'd want to test the waters to 25 now, in September, 25 maybe in October,
right,
and then take a pause till next year, and maybe in February is when they will do bigger rate rises.
Okay, and now how will markets react, and how will that rate increase impact on business and industry there?
Well, I think the immediate reaction from the market might be negative because people have been. It comes down to asset allocation. Asset allocation will need to change as soon as the Fed starts raising again. It's become a reality that the rates are going to rise. And that will create short-term turbulence in the market. But we see that as a buying opportunity rather than a long-term negative for investors.
Okay, now what about those US banks? You hold, Wells Fargo, you hold some JP Morgan. What's their outlook?
Well, the short-term outlook for them is actually pretty good. They have positive earnings momentum going forward, and if you listen to how the management have actually structured their balance sheet, they're waiting for the rate rise. They can't wait for this rate rise to happen because that basically will mean that a few $100 billion of deposits that they have on their books that are earning zero interest at this point in time will actually start earning positive interest. And as an example, Bank of America basically said that 100 basis point rate rise will mean an additional $4.6 billion in revenues to them, and that will drop straight down to their profits. So in the short run, medium term, And even in the long run, a rate rise is good for all these banks, and we think their earnings profile will improve significantly.
All right, but you did say other parts of the market, when interest rates start to rise, you know, will be tricky for them because they'll have to readjust.
Yeah, that's true. Like if you look at businesses, so in the last 4 or 5 years, businesses have had easy credit. Credit costs have been, the cost of credit has been really cheap for them. As rates start increasing, the lower profitable investors and the lower profitable investments, which were relying on low interest rate environment, will start to suffer. So what you'll see is a clean out of all these poor investments that have been made just because rates were so low.
How do you compare those banks that you hold in America to Australian banks?
Well, if you look at what's happening in the US, the US has had a number of different things. The regulatory environment in the US is more settled than Australia. The rate rise environment is on a positive, so when rates change, it's actually a positive for the US banks. You compare that to Australia, there's still uncertainty about what the RBA is going to do and what APRA are going to do in terms of mortgage risk weights, corporate risk weights, and total capital levels for banks. So there's still that uncertainty there. So from an uncertainty and also a macro environment perspective, we think the US looks a lot better than Australia at this point in time, and the US banks probably have better earnings momentum, have better earnings outlook over the next 12, 18 months than the Australian banks.
So are the banks in the US the only sector you like there?
No, I think there's a number of others. The financial sector in the US is still depressed, and that's why we think that for investors, that's where the easiest money right now is.
Yeah.
And then in terms of, if you look at the consumer sector in the US, as the macro environment starts improving, consumer sector, particularly the beverage sector, particularly the retail sector, are likely to see a benefit from retail investors basically having more cash and being more confident to spend.
Yeah. So sorry, go on.
So from that perspective, we think anything that's consumer related in the US is probably looking better than capital related.
Right, and just really briefly, did you get the feeling that they're all feeling sort of super confident that the recovery is well and truly on?
Well, I don't think the businesses were saying that they are more confident now than they have ever been in the last 5 to 7 years. But nobody's super confident because they still look on the other side of the ocean at Europe and say, well, what could that cause to us? Any disturbance there, what impact could that have to us? But the general feeling that I've got from talking to all the businesses is that they're a lot more confident now, and they think that they can it'll be a slower, longer recovery.
All right, Uday Cheruvu from PM Capital, thanks so much for joining us.
Thank you for your time.